Stocks continued a very strong rally, a pretty decent move from Friday's close, an even more impressive move from Friday's low point that we had right within maybe like what, an hour before the close. So we've had a really tremendous move to the upside. Ryan Dietrich just tweeted out that usually leads to really good returns going forward within 6 months, within a year. Is that going to be the case this time? Are we set up? Is the technical environment set up to produce a good new intermediate run, a good new market sentiment run? Have we had the kind of pattern this last few weeks that sets us up for this big bounce, right? Think of a trampoline, right? You get the bigger bounces when you've dropped the most, right? Well, have we dropped enough? Has the technical environment set up enough to really propel us for more than just a week, like we saw in March, like we saw in February? Like we've had moves like this before in the year to date. So I'm going to break that down and show you what I expect to go forward from here and why. And then we'll take a look at our trade idea of a stock that kind of like some of the other stocks that we've done, or trades we've done here, more bullish to the upside, add some positive deltas to our portfolio that's been pretty full of negative deltas, add some more positive deltas, and we'll talk about how to trade a stock that's been really beaten up but might be finally reversing for the first time. So let's take a look at that. Let's go ahead and get started. Today is Friday, May the 27th, 2022. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, I wanted to start off really quickly before we get into the charts. Take a look. We got our very first super thanks support here on Tuesday in Brandon's Market Outlook video Tuesday. We got a $2 tip from Peter. So thank you very much, Peter, for that. We really appreciate that. It's the very first time we've ever had that. The way you do that is you click on thanks right below the video there where it says click on show support, and then you can do $2, $5, $10, whatever, and then click on buy and send. So I wanted to point out that it is a Memorial Day weekend, and if you come up here to pricing and click on this pricing, and you can see all of our plans, our monthly plan, our premium plan. If you click on that subscribe button, we actually have a Memorial Day sale going on right now for our premium subscription, 20% off of that $29.70. It works out to $23.76 for 3 full years of access to our site using the coupon Memorial Day. This is the coupon code. So right where it says coupon code here, it'll ask you if you have a coupon. Click on that box, it'll open it up and type in Memorial Day, capital M, capital D. It is case sensitive, no space in between. Type that in there and finish out filling that out. If you want to do 6 months, same as cash, so no interest, same as cash. You can pay with your PayPal account. You can create an account there, and again, through their PayPal credit, it's not through us, it's through them. They can give you 6 months, same as cash. If you do that, we figured out that the total would be $3.17 per YouTube video for the next 3 years. So if you're thinking, hey, I would tip you $2, I would tip you $4. I would tip you whatever. I'd tip you $5. Well, if you would tip us $5 for every video over the next 3 years, then you might as well sign up for our premium service, because you'll get all of this in addition to all those YouTube videos. These showing support for those YouTube videos. So just a thought as we head into Memorial Day weekend. Again, it will expire at midnight Monday night. The Memorial Day sale, so take advantage of that. It's this Memorial Day and the coupon code, and it's only for our premium service. All right, now let's take a look at how the S&P is doing. And look at that rally. Look at that 3-day move, really a 5-day rally coming off of that hammer pattern that we had last Friday. So really, really good week. We haven't had a good week. I mean, this is the last time we had a good week going into that expiration, into March expiration. So really good week here coming out of this expiration cycle. Near-term line getting up above 90. That's a good sign. The intermediate line's rising out of the reversal zone. Good. We did get above the 30-day moving average. That's what produced the yellow line because it's still falling. And we got light green shading because we were rising up above 20. So that's a pretty good sign, but that's also a really bearish signal. We've seen some stuff like this before. Flip side would be light pink shading in yellow line would be a good bullish signal. So it's basically the flip side of that signal over here, and it'd be a kind of the same thing that we got over here. when we had a pretty decent 5-day rally going into February the 2nd. Again, that one didn't quite get above the moving average, but it did get the yellow line because the moving average rose briefly there. So, but it's a good sign nonetheless. If you take a look at the weekly version, you can see the short term. I mean, as bullish as this week was, and again, we haven't had a week this bullish since that March expiration week right there. As bullish as a week as this was, that week got short-term sentiment up to pretty decent levels. The momentum line got into the reversal zone. The near-term line got there, but they were so oversold here that we're just barely getting into bullish, and the intermediate line still in oversold levels, and we're still 6.5% below the 30-week moving average. And for that matter, we're also still below resistance, right? We've got that strong resistance between really this 41.25 at 38% retracement of this drop, and then up here to the 38% retracement / 23% retrace. This would be the 38% retracement of this market sentiment drop, year-to-date drop. The 23% line goes to the post-COVID rally. That was a support for us when we were coming down, and we finally broke it. Now will act as a resistance. So multiple layers of resistance, and you got the 50% retracement right above that. So you got multiple layers of resistance here between 41.25 and 41.225. So about a 100-point range, which is a typical average right now. You know, there's a really good chance that we kind of trade in that range next week coming out of the holiday. Breaking through that range would be great, but staying in that range, and maybe even, you know, depending upon what kind of, if we get a long upper shadow, kind of like what we did over here on the weekly chart, if we get a long upper shadow up into that resistance, then, you know, obviously that would be a bearish sign. But it is interesting, like if you look at the 5-day rate of return here, because it was such a good return, let's go to the rate of change, and let's change this to a 5-day chart. If you look at that 5-day rate of return, it's a pretty high number. Like it got up to 6.5%. So this was earlier today when I tweeted about it. 6.5% here. And again, if you don't follow me on Twitter, I would recommend that you do that. I've been putting a lot of stuff out there over the past week. You can see all the charts and different things that I'm posting throughout the day. Multiple tweets day by day. So if you're not following me, again, my handle is David Settle at David Settle 42. And then there will just be a follow button there. Just click on that follow button and you'll be able to make sure. And then make sure that you just like the tweets, right? The more you like the tweets, the more Twitter knows you want to see my stuff, right? So just get in the habit of when you see something you like, let me know. It lets me know, number one, that you liked it. And number two, it lets Twitter know that you liked it. So you're telling Twitter, keep showing me David Settle's content, as well as Brandon's and Market Outlook, Market Scholars and all of that. But when you look at, so I posted this earlier, this is about as high as we got. But you notice we kept going up. So just because we peaked at 6% didn't mean that we didn't keep going. You can see that the 5%, the 5-day rally, the return just dropped, right? We just started going up at a slower pace. We didn't, remember on this rally here, I've shown you before, we didn't have the resistance that we have now. So needless to say, this is a relatively high level. We were coming off of that intermediate low point with this kind of return. We were coming off of the 2018 low point with that kind of return. We were coming off the 2018, early 2018 low point with that kind of return. Very, very significant rally to the upside. You can see if I were to go back a little bit further, go back over here, and you can see there's our 15, 16. You notice we didn't of all those periods, we did not get this kind of return. And then you can see 2011, we had returns up to this level. But you notice there, that was kind of the peaks for a lot of these moves. We peaked at these levels before rolling back over to the downside. Again, different resistance levels. And that's the case now, I believe, that we have different resistance levels that we didn't have on a lot of these other moves. And we're peaking at. And the other thing, too, that really kind of stands out is that McClellan oscillator. I tweeted about this as well, breaking above 100. This is the first time that the McClellan oscillator has broke, with the data that we have here on Thinkorswim, that has broken above 100 without falling below minus 100 first. The only other time that is anywhere near that kind of pattern is 2016. where we didn't drop below, but we did drop below to get to minus 90, and we haven't dropped below minus 70 this time, and we also got below minus 100 at the beginning of that correction. So we still haven't gotten below minus 100 at all. Even at the beginning of the correction, we didn't get below it, and we're definitely not coming off of it now. So much different pattern. So I believe, and you can see too, I tweeted this out about the VIX today. So here's those same rallies, those same 5-day rallies. Here's the drop in the VIX each of those times. Big drop. I mean, not as big, but pretty decent sized drop. And then there's today's drop. Right, you can see not very much of a move at all in volatility. So what that tells me is that the market's giving us the impression that this is the low point, and this is the thrusting move that you typically get off of these low points to get us above 100. Right now, that you keep in mind that you also typically get a break above the Bollinger Bands. The bandwidth is still really high, but you typically get a break above the 100 level on a low bandwidth. We don't have that right now. So I think we still need to consolidate down here and bring the bandwidth down before we can finally get that breakout. We didn't even get above 75 today on the Bollinger bandwidth. And again, you can see all the resistance up into this area here where all this volume is sitting right on top of us. A tremendous amount of volume there. If you take a look at the weekly chart and how we finished, we did get a transition candle. We've seen this before, right? We got that on that same March week, that same week that we had such a big move. The last time we had a 5% rally, which is right here. The last time we had a 6.5% rally. Last time we had a 5% rally, almost 5.8%. We followed up with a small range, small move. This a little bit different this go around because there you had a 4 out of 5 week losing streak. Here you had a 7-week losing streak. So a little bit different from that perspective, but a good week nonetheless. So the last time we had a really good week like that, we followed it up with some pretty bullish candles. Keep in mind, I showed you the hull on the daily chart. A very good bullish candle there finally yesterday, rallying up more today. Here's what it looks like on the weekly chart. Again, there's there's the same candle we got on March 18th. It's the same one we're getting right now. We're above the 200 week moving average. This would be the 200 week hull. This still hasn't dropped yet. So as bearish as we were in 2018, it did drop. As bearish as we were in COVID, it did drop. We've been pretty bearish this go around. It still has not dropped. So we still haven't got that red line rolling over. You can see the red line rolled over about the time we got our transition candle and reversal there. The red line rolled over about the same time we got our transition candle and reversal there. So here's again our transition candle. We are further below the 200 week moving average than we've been. We were a little bit more below it on the COVID drop, but this is pretty decently below it, and we're getting a transition candle. Not the first one, we got one over there. Let's see if this ends up being the one that flips us back around to the upside. You can see the parabolic SAR is way up there. It's going to drop down next week, but it's going to probably drop down towards where resistance is in this area. Right up, there's that resistance at 41.25 or 4,200, excuse me. 42.25 would be just a little bit above that. So you can still move up into that area and not flip that parabolic SAR around on that long-term chart. Let's take a look at the 3 green arrows. So look, we got 3 green arrows. Boom on the S&P, boom on the Dow. I feel like I'm John Madden. Boom on the Russell 2000. But we don't have it on the Qs yet, right? You would assume that we will. Now here's the issue. Getting 3 green arrows is great. Getting it for a day or two is not so good, right? You want it to get it and stick. Stick above that, get above that moving average, stick there. So it's one thing to get it, but that can be a very bearish pattern when you get 3, just like when you're bullish, getting 3 red arrows is actually, I know Invest Tools, or who I used to work for a long time, used to teach the 3 green arrow system. And you would buy on 3 green arrows, and that's great. But actually, the buy signal in a bull market, the buy signal was actually 3 red arrows. You flip that around, it's the same thing here. 3 green arrows is actually a pretty decent sell signal in a bearish market. Obviously, there's going to be a 3 green arrow signal that flips it around, that gets it going again. And if that's the case, then it's going to break above that moving average by, in the case of the S&P, 2.5% or more. And remember, we're less than 0.8% above it. So, and we still have, it can actually go up to 42.36, I believe, is what we calculated today in class, and still be below 2.5% above the moving average. So watch for Tuesday, Wednesday, that it stays green. If it can stay green by the end of next week, we're good. We're good, right? We got a good trend going here. Who knows how long it will last, but at least we have the beginnings of a good trend going. If, however, we only get 1 day, maybe 2 on Tuesday, then we flip back to no green because we're back below the moving average, because you're not going to get a red arrow on the MACD anytime soon. So the only way you get a red arrow to get rid of the green shading is on the moving average. If we get one of those on Tuesday or Wednesday, then we know, okay, sell signal, right? And we'll know really quickly. That's why 3 green arrows is such a good signal. We will know really quickly. If we keep going up on Tuesday and Wednesday, then a good chance it will stay green for a while, and we'll take whatever loss on any bearish trade you make because of that signal. But if it rolls back down, and as you expected it would, because it's 3 green arrows in a bearish trend, then here we go, right? We're going back to a new leg lower to the downside. Here's some of the other oscillators. You can see the positive really broke out. It has not crossed 25 yet, so keep that in mind. But at least it's not bearish anymore, and the negative, you notice, has not crossed back below 30. The Qs is the same pattern, and IWM, the negative indicator has dropped below 25, but the positive hasn't. So we need to get that positive above 25 at the very least, and then of course getting it above 30 and negative below 20 gets you a breakout, a trend to the upside. Looking at the RSI and CCI, we're kind of in that fake out mode. You got to get above 60 to really solidify. And we actually did there, and it didn't solidify. But see, we got above 50 on that move in February, and it didn't. That got up to the moving average and turned back down. So that's the danger of the pattern we can get right now. Same thing. I mean, that's a pretty decent. It got above 150. That's a pretty decent CCI for the S&P 500. The NASDAQ did not get above 150. The Russell 2000 got above 200. So the Russell 2000 is more bullish, but you notice it went right into resistance today. So, again, you expect resistance to hold until it doesn't. And maybe we went up too much. Maybe the 6-7% rally was too much. Maybe we pulled forward, a couple weeks worth of rally into this week. And now we've run out of potential energy. Because remember, again, we are in a bearish trend, not in a bullish trend. Looking at the Ichimoku cloud, we still have a mature bearish trend. It's falling, but it's still below -5 and it's still above 80. And we're above the blue line. Again, if you're above the blue line, you can be above it for a day or two, and you might come right back down. So you can see how important Tuesday and Wednesday are becoming as to whether or not we're going to maintain or start a new leg to the downside. Take a look at, we looked at the Bollinger Bands. Let's take a look at that one more time. Again, you can see we got up to the upper quartile, and we've done this before. We got up to the upper quartile there, and it didn't break out. Also, over here, we got above the midpoint and didn't break out. So we got to really break out above the upper band to change this trend. We just can't do, like over here, you didn't break out above 100 all the time, but you were on a bullish trend. If you're going to change a bearish trend, you got to move it around. And unfortunately, the odds of that happening are really low when the bandwidth is already still really high. It just gets really hard. What happens is we just kind of consolidate, and you can see how the bands have come inside the Keltner channel. So you have a red dots. We're going to get new green dots at some point in time on a new leg lower to the downside. So let's see when we get that new green dot where the bands break back outside of the Keltner channels. You can see you kind of got that a little bit here. You got green dots on a bullish move. Over here, you got green dots. You got the bullish move, but you had it during red dots. So you've got to get the green dots and the bullish move to get the possibility of it even having a chance of changing this trend around. Okay, let's take a look at the intraday move here today. So you can see here, we did get a higher high and a higher low. We did close above yesterday's high. We closed above last week's high. So about as bullish as you could possibly be. considering that we were pretty bearish last Friday before that late Friday rally. And so we've really moved higher. 415.35. We talked about it's up 6.8% on a weekly basis, but really, 415.35. We've really come up off of Friday's low 9%. Right, we're up over 9% off of that low point. So that's a pretty decent move. And again, you wonder, have we kind of blown out all of our gas, right? If we've gone as much as we can go because we've kind of pulled forward a really strong move into a smaller amount of days, especially without the volume, right? You'll see here in a second, not necessarily the best volume. Remember I talked about the Arun indicator, the stages of reversal. The red line's got to fall below 70, and then the green line's got to fall below 0. So unless we get a new low tomorrow or Tuesday or Wednesday, the red line's going to fall below 70. The question is, though, when is that green line going to spike from 0 to 100? And so when are we going to ultimately get a new 4-week average? Next week, that's going to be the high for quite some time. At some point in time, though, that's going to be the high. We don't have to break 430 to get a new high, because by the end of the week, this is going to be off. By Friday, that's going to be off, and you'll have a new one. And you can see. Outside of that, the high points were about 425. That's going to be going into the following week. That's going to be where the high point is. So unless we break 425, we're not going to get that spike from 0 to 100. So you see where the level is now, and that's the top of the resistance area, right? 425. So we'll see if we end up getting that breakout on the Arun indicator by the end of the week, because that would also signal a break up above resistance. One thing, again, that kind of, to me, suggests the lower probability of that scenario happening is the fact that the VIX is just not moving at all. And really, the issue for the VIX is the VVIX, right? The VVIX, the volatility of the VIX, has dropped below 100 for the first week in a long time, right? It did get below 100 there in March of 2021. You can see the VVIX jump from there. Same thing in September of 2020, it jumped from there. And I showed you previously the moves in volatility that were higher during that period. And both those periods, you can see we were down below 85% there on the VIX relative to VIX 3M. Over here, you were below 85% on the VIX relative to VIX 3M. Here, you're not even below 90%. So the VIX, for where for the VIX relative to where the ATR is and relative to historical volatility is really, really low. The VIX relative to where the VVIX is really high. So what that suggests to me is that the market here is, again, when the VVIX spikes, volatility goes with it. And if volatility is really, really low compared to where the ATR is, then that suggests there still is a volatility spike, similar to what we saw with COVID, similar to what we saw in 2018, a jump to 115 to 125% or more on a closing basis. That's still coming. We never had that. All year long, we haven't had that to begin this correction. And if we are ending it, we haven't had one to end the correction either. So I don't believe we are ending the correction. I believe that volatility spike is still forthcoming. Whether it happens before June expiration or not, obviously nobody knows. But we'll know Tuesday or Wednesday really quickly, based on what I told you before, whether or not we'll at least begin a new leg lower that could produce that VIX capitulation and bring the VVIX back up above 100. Remember, as the VVIX rises back above 100, that means the VIX is expanding out and getting bigger. Bigger moves on the VIX are associated with higher moves on the VIX, not lower. So definitely something to keep an eye on next week. What do you think? Do you agree with that assessment? Do you agree with my expectations of, the fact that I lean more towards that we'll be starting a new leg lower sooner rather than later? Do you disagree? Let me know in the comments section below, especially if you disagree. Let me know what charts or indicators are you looking at that suggest why you're either a lot more bullish than I am or a lot more bearish than I am. Before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That notifies you when our videos are posted. Also, while you're down there, hit that thumbs up icon. That tells us that you liked the video today and that you want us to do another video on Tuesday. Quick way to let us know you like our stuff. If you don't like it, you don't have to click on anything. If you do like it though and you want to let us know, click on it right now while you're watching, and that goes a long ways for us. So we really appreciate it. It really helps get our videos out to more and more viewers, so it's a way that you can also help us out. Subscribe to our website at marketscholars.com. There's a link popping out up there in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content between the videos from day to day. There's my handle at DavidSettle42, and join our Market Outlook Facebook group that we've created. All right, if you're watching us on our blog, check out some of these other things over here on the right. You can see our Market Outlook live video. Click on that link. You can also come up to Market Outlook and click on Live Trade Review. That takes you to this page. On Monday, Wednesday, and Friday at 3:30 Eastern Time, before the market closes, on this page, I do a live video for about 10 to 15 minutes. What I do is I cover all the trades I put on and all these old Market Outlook videos to see whether we should stay in them or get out of them and how to manage them. It's really probably the most important part of the trade. So that's where I do that. I also, before the market closed today, I already put on today's trade idea that you'll hear at the end of the video. So it's a way to kind of get a leg up, so to speak, before the market opens up, in this case on Tuesday. Come down here, you can see our upcoming classes that we have. Click on View More. It takes you to our calendar for the rest of the month. It also goes back, and we'll have June's calendar up here on Tuesday, but the recordings go back for 4 years, so you get 4 years worth of recordings. Lots of content on that calendar. Come down to the bottom, click that heart. We almost got to 100, so let's see if we can, on the holiday, get to 100 likes there. Click on that heart, it takes you to that like page. You can do that right now while you're watching. Also, click that thumbs up icon, takes you to this page. Click on like. Again, you can do it right while I'm talking here. Again, it really helps us a lot. It helps us so much. You would not believe how much it gets our content out, the more likes and shares and retweets these have. It also benefits you because Twitter and Facebook promote content in your timeline from the accounts that you engage with and like the content that you engage with. So the more you click on this, the more you get our content as well as content like the stuff that we put out there. All right, now let's take a look at what's driving the price action today. And look at that rally, 7% rally for the Qs, 6 2/3 for the IWM and SPY. Really, really good move to the upside. You can see one of the main drivers is this risk-off move, especially in the dollar. The dollar is really dropping pretty hard. But keep in mind something about that too. That's another one of those, like, this doesn't look like the kind of moves that lead to big intermediate runs or big market sentiment. Because not only are we going to be starting a new intermediate run, at some point we're going to be starting a new bullish market sentiment run, where the market sentiment comes from where it's at in bearish territory back up to bullish territory. So again, and that's like a 6 to 9 month rally. So if we're going to really be starting that, then typically what you see is a rally higher to the upside in the US dollar Japanese yen currency pair. But the problem is it's already spiked to the upside. In fact, if I zoom out, you can see the nice little rally it's had. There's the COVID rally, and then it kind of pulled back. And then really it's rallied pretty sharply off of 102 all the way up to 127. This is a tremendous move to the upside on the US dollar yen pair. And you can see right now it's been dropping, right? The dollar's been dropping, and that's been bullish from a market aspect. But it was also really bullish during that spike when we've gone pretty parabolic here. And when this pair drops, it's typically, you can see there with COVID, and you can see with the fourth quarter 2018, the first quarter 2018. When this pair drops, and you can see during that, during 2019, that's when we had the mid-cycle, the Fed had to step in and do the mid-cycle adjustment to keep that going. So it's typically a reflection of risk aversion. Same thing with the dollar franc. The yen and the franc are typically associated with risk aversion. You can see the dollar dropping pretty sharply there after having rallied quite a bit, again, off of that low point. In fact, if you look at how the currencies have paired this week, if I do a currency comparison chart and then go back to this week, so let's go to May, go out here. So here's how they perform. The dollar was the worst performing asset class, and then there's your yen, again, safe haven trade, right? The yen is a safe haven aspect, safe haven currency pair. The franc is in light blue. The franc actually did pretty well this week and outpaced a lot outpaced the euro, way outpaced the pound, and outpaced a lot of these other commodity-related currencies, including the Canadian dollar. So it makes you wonder a little bit just how risk on this move has been, especially when you see like TLT, like it's not really like dropping hard. In fact, it already has dropped hard during the rally. And again, when bonds rise, it's typically risk off, not risk on. And so if the dollar's expected to drop against the yen and against the franc on a long-term basis, if TLT is expected to rise on a long-term basis because it's so oversold here, then again, that's not going to be associated with the market rocketing back up to new highs. It's going to be associated with a new leg lower, where now these relationships that were not in alignment with that pullback are going to be. Let's see if this has been updated yet. So here we go. Look at this. Here's another. So this is new highs, and it might not be completely done. I think they get data because there's multiple exchanges that they use. I believe they use the NASDAQ and the New York Stock Exchange. But as of right now, the new highs, new lows has broken up above a zero. Now, it did that again in the end of March, right? And there's that week going into 100, going into zero the week of that February, the beginning of February. There's that break, that big move, that big rally up. We got close to zero. It's not like we haven't been above zero. We've been above zero. It's got to get above 100 and stay above 100 to really kind of flip this move back to the upside. And so again, you see how important next Tuesday and Wednesday. Can we break through this? Can we push on that McClellan oscillator up to new levels? Can we push this up to new levels? And we're just not quite there yet. But when you look at some of these other oscillators, remember how we looked at HYG relative to LQD and how it hadn't dropped, it had just barely started the drop. The markets were dropping, but this was still at really high levels. Well, look at the rally here it's had this week. A big, sharp rally, even though its long-term PPO is still extremely high. So again, I think you're getting an oversold rally and risk aversion, and that's bouncing. Risk appetite's bouncing. I don't think necessarily that we're done trending. Here is when you look at it relative to treasuries. Again, you can see that, look at that big drop there. So just like that, it's almost like we haven't been bearish at all. And according to these risk off measures, look at that big pullback in the MACD, the histogram's rolling over, that we're down low here. So as oversold as we are in these areas, and that's against HYG. If you look at LQD, you can see same thing. We did fall down there too, down to that 50-day moving average. So and it's still rising. It's rising even more than HYG is. Because HYG has been so bullish relative to LQD. Again, if we reverse these moves early next week, then we know what's going on. If they can break these levels, and there's not a whole lot more to break down because they're already still so low, but if they break these levels, you can see we might be bullish for a while, and that ultimately might lead. The problem is, you can see when we were at 2018 and we started that fourth quarter, we started this rally, we were almost up to 1. On here, we were well above 1 at the COVID lows before we started. We were at 97 there, 99 here. We're only at 92 here, so these are hardly levels that you would expect. Oh, we've been so bearish now, we should get a good bullish run coming out of it. There's 15 and 16, we were at 1.06, and there's 2011, we were at 110. So again, you see how we're not necessarily as bearish. I mean, even 2018, we haven't been as bearish enough to say, oh, let's get a new big strong rally going here to the downside. Now let's take a look at how the sectors performed here today. So this week, let's bring up the sector comparison chart and come over here to May the 23rd. So here's the move. You can see XLY, XLK doing very well. XLE taking advantage of the weakness in the dollar, not XLB. Bond yields weren't really too much higher, and financials really rallied regardless. Right? Financials would rally if, where did that chart go? If the yield spread were to rally. Here, let's refresh this page. But you notice the yield spread hasn't really rallied this week. It's actually been pretty flat. Hasn't really gone anywhere. So that's not necessarily bullish for financials, yet financials really rallied sharply higher. So again, it kind of, and you can see XLC, I mean, XLY was really bearish going into Tuesday, and look at that move. So XLY has had even a much greater, it went from being down 3% at the beginning of Tuesday to finishing up 9.5%. So again, have we pulled too much rally forward into this last so many days? It sure makes you wonder, especially when things are rising, for when the relationships that reflect how bullish they are aren't rising to the same degree as we saw there with that yield spread. All right, so for our trade idea of the day, I wanted to take a look at Square. Square is interesting. We've been bearish on this before and done pretty well with bearish trades, but and we've been doing pretty well on our recent bullish trades that we've been making lately in the market outlook videos to take advantage of this weakness. So and I want to stay in that direction here with Square. Square had a, it's been bearish, but this is its best short-term break that we've had in a while. Now, see, it had this kind of move over here, and it didn't quite take. So keep that in mind. This isn't the end-all, be-all. It's not necessarily going to like take off to the upside here, but that is a bullish move nonetheless. And if you take a look at like the weekly chart for Square, again, you're getting a transition candle. You can see the PPO is really low, minus 31%. Your Hakinyashi differential is really low and starting to rise back to the upside after having been so bearish. When you look at the 3 green arrow chart, when you look at the 3 green arrow chart, we did break the 30-day moving average, we did break the 17-day moving average, but we still got the 30, and the 50 is right at the point of control. The MACD is rising, the stochastics is rising. When you look at like its directional movement index, not nearly as bearish as we were. The negative indicator is below 25. The positive still got some room to go, so we're not breaking out here in the least bit. The RSI and the CCI are no longer at bearish levels, so at least they're trying to break out to better areas. And you can see the trend strength has been pretty strongly bearish, but we are getting above that blue line, very similar to the broader markets as a whole. And then if you look at the Bollinger Bands, again, we did not break into the upper half or the upper quartile. We did not break above the upper band, but we've been so bearish that just getting above the midpoint's been a good thing for this, even if it's just a little bit. You still got very strong resistance. So what we decided to do here is like, okay, if the markets are going to be a little bit bullish here for a while, like I said, we've got some bullish delta trades going on. That's been very helpful. Well, let's take a look at doing a quick, relatively higher probability bullish trade on this. So we'll buy the 92.5 call, sell the 95 call option. That gives us this trade here. Let's go single symbol. That gives us this trade here for, again, for half the risk of what we normally do, because it's a directional speculative trade. It's a low probability trade. We're more than likely going to lose money on it because that's how it works. But if we do make money on it, we'll actually get a better return, or about double the return of what we normally get like on our short put vertical spreads, but for half the risk of what it takes to get that return. So when typically we're risking $3 to make one, we've kind of flipped that around a little bit. And here we're risking $3 to make, instead of just one, we're making about 4.5. But we're not risking $3. We're actually risking less than what we normally risk, $1.50. So a good opportunity to make a pretty decent return, relatively high probability. That's how much wiggle room we have to work with. The stock, this can move in as time passes. You can see that gray area moves in, but you see how much wiggle room we have to work with before it's out. I mean, pretty much all the way up to expiration before it's out of range for an opportunity. All right, well, that does it for today. You've heard from me. Now I want to hear from you. Use that link that's popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new thread there with any questions or comments you have. Reply to other people's threads. And let's keep this conversation going in between videos. Again, thank you very much for watching. Have a great Memorial Day weekend. Remember to take advantage of that coupon that I showed you at the beginning of the video. And we'll see everybody next week on Tuesday. All right, goodbye, everyone.